Hi guys, thank you for joining me again. This is Christopher Aaron coming to you on the weekend edition. It's October 17th in the early morning hours, and I wanted to get this update out to those of you who find this useful. Thank you for joining me again. And I'm trying a little different format here this time, so please bear with me if the technology isn't perfect. We'll see how it goes. But I just wanted to put a face to the voice and to the presentations because I think it's a little bit more meaningful that way. So I'm going to try to keep this here open in the corner, and we'll see how that goes as we get to the action in the metals. How about we move it like that and just have to do that. That should do it. So I wanted to bring up a little bit of a historic example today for those of you who are maybe of a similar disposition to me and you're a little bit obsessed with following the markets on a daily basis. This is really for you. Um, I went through a period of time about 10 years ago where I was really focused on that day-to-day action. And I want to bring up this historic example just to keep things in perspective. So this is a topic for another day as far as the actual historical event, but just to put it into this context, Germany went through a hyperinflation from roughly 1914 to 1924. And during that time, they completely devalued their currency because they were not able to pay back their war debts, and they just started printing money to pay for everything. And as most of us know, that really doesn't work. If it was that easy to just print money to pay for things, no one would ever have to work or do anything. So when Germany tried this, they went through this hyperinflation over the course of about 10 years. And I'm not here to say that the US is going to experience that exact same scenario. Could it happen? Maybe, but we'll see. But at any rate, I wanted to show you an extreme example here, just of the value of the currency compared to German marks compared to the price of gold over the course of this time period. And so look at this. You had a price that went from about 5 to almost 25. Put this in dollar terms. Let's call it gold going from 500 to over 2,000. And then look at this drop here from 2,000 down to 1,000, which would be this level. So you had here over a 50% drop over the course of a little less than a year. And this drop must have been enough to really scare anyone out of the gold market in Germany in the early 1920s. Now, for those people who were too obsessed with that short-term action and who didn't understand what was really happening, they missed out on what this move became. And let's look at that on the next slide. So here, this shows that decline that we were just looking at. And here you can see over the course of the next 3 years, you went from that low of around 10 in 1920 to, what is that? A trillion. So you went from 10 to a trillion marks per gold ounce. And the point is for anyone here who got scared out of over a 50% correction, who did not understand the fundamentals, that was a costly mistake. So I bring that up just so that we can look at this next chart. This is the one I bring up quite often, and it is that gold chart from 1980 to the present. And again, we've had what is almost a 50% correction here of the entire bull market. Is it a coincidence? A similar percentage as what happened in Germany before their hyperinflation? Very well could be a coincidence. But for those of us who are looking at this, or for, let's say, people in the mainstream media who are looking at this and saying, well, gold has fallen 50%, therefore it's done, it's a bear market. It's going back down to 250 per ounce. There are some strong historic examples to show times when that was not true, such as in a much more serious inflation than we even have in this country right now or in the immediate future. So let's just keep that example in mind as we go along, that I love to look at the day-to-day action. I love to see how it plays out. It's exciting for me if I can make short-term trades that make me money on the side as I'm investing long run, stacking the coins, buying the physical metal that I can. If I can make some money in the short run, that's great. And if not, it at least gives me something that is exciting to watch unfold on a day-to-day basis. So let's get ready into that. The last 3 days of the gold market action, not a whole lot of movement here, kind of closing in the mid-range of the last 3 days. Let's move right along, just put that in perspective. I am going to make this a tiny bit smaller if I can. Maybe move it down just a little bit. There we go. So we can see more of that chart. So here we had the triangular consolidation. We had this breakout that I talked about last week, and I said in the last video we could have some back and forth motion before we start accelerating to what I believe will be the next target here around 1230 to 1245. And where do I get that target from? Well, because we broke this trend line, so that is now a broken turquoise trend line. And once you break a trend line like that that's been going on for about a year, we typically will have a significant move beyond that. And in that case, that move is looking to come right in here as we back up to the 7-day chart, the 7-year chart. We're looking at a target right here that is going to bring us somewhere in the upper range of this multi-year downtrend that we've had going on, shown in the bright blue, the primary downtrend that we're in right now. So we get our target from there. We say we broke this trend line, so where are we heading next? The next logical test is right here. And so these lines aren't arbitrary. These lines, if you look at this, I mean, look, 1 hit, 2 hits, 3 hits, 4 hits on the downside, 1, 2, almost 3, and 4 on the upside. So we'll be looking for a new hit here. And so we like to reevaluate this market every time we get a new hit on a major downtrend. Again, this downtrend being that bottoming process from a 50% bull market Fibonacci retracement level, similar to that 50% retracement that happened in Germany before the price of gold took off. So not time to lose hope, but not time to lose track of the perspective, even as we watch the shorter term movements play out here. Moving right along to the silver side. Now, some interesting action here. Look at all this consolidation. Look at all this really compressed action here, except for this spike down on Wednesday, and then a strong surge again to finish Wednesday. You've had the price just stay right around this $16 level. Now, this is not random. So remember this action on the next chart. Now look at that. We're bumping right up against this primary downtrend line here in silver. And if you look right in here where this red circle is, this is showing you that action here. So there's a reason why on that previous chart you see that back and forth action. That's right here. That's because there is a primary downtrend going on in silver that is attempting to be broken out of. And that takes a lot of buying. It takes a lot of people coming into this market, whether they're traders, speculators, hedgers, physical purchasers. It doesn't matter. All the buying is coming in, and then the selling is coming in. So you have a battle going on right now, right around the $16 level. It's very interesting to watch it play out. And we do think that when this breaks, we will have a significant move here to the upside. It might not happen right now, though. Let's just put that into perspective again. Let me move my video over to the other side. I think that works a little better. Got a little noise there in the background. We have this primary downtrend line here that we are bumping up against at 16. So that's why you're seeing that. That's why it looks like it's really struggling to get above that, because this is a very important line. There have been sellers, there have been unique sellers for the last 3.5 years coming in at lower and lower and lower prices. And now some of them are coming in here at 16. Whereas earlier on they were coming in at 17. In 2014 they were coming in at 22. Now those people are selling here at 16. The important thing is, look at this. This is a wedge pattern. So these sellers are coming in, and when they get exhausted, when there's no more sellers here at this level, you will tend to have a pretty strong move in the opposite direction when that line gets broken. So that's why we're watching for that. It is a bottoming process here happening in silver. And so let's just give the summary here. We're looking at that target 1230, 1245 on gold. Silver still bumping against the 2-year downtrend, a very important downtrend that we're looking to break. And as we said in the very first slide, the historic significance of these bottom formations, it is my personal opinion that something of a historic magnitude is unfolding here. And I don't mean that this is going to happen today or next week, but when we look at this process over a period of time, you have these metals that are regaining a very important investment demand from a store of value, not just from the commodity standpoint, but the store of value of these metals. And you're seeing that play out in the charts right now. So if anyone is interested in the technical side of things more, I do publish some articles that are available for free. And I'm just going to provide a link for that and mention that here. It's on the website silverphoenix500.com. That's the sister site of Gold Eagle. So that article is up there for anyone who's interested in the real technical formations that I'm looking at that show me that we're approaching this significant bottom in silver. If you find these videos to be of value, please subscribe. If you think there's anyone else who likes to follow the day-to-day action in the metals, that is a little bit obsessed with following it like I am, then please share it with them. And thanks for joining me again, guys. I will see you in the middle of the next week as market conditions warrant. Have a nice weekend.